In the world of crypto trading, many traders believe they are competing against the market itself. They imagine price as a natural force that moves randomly based on news, technology, or sentiment. Yet beneath the surface of every market lies a quieter and far more structured mechanism, one that rarely appears on trading charts and is rarely explained in simple tutorials. That mechanism is liquidity, and understanding how it works reveals why so many traders feel as though the market moves against them at the exact moment they enter or exit a position. Liquidity, in simple terms, refers to the availability of buyers and sellers in a market at any given moment. Every trade requires someone on the other side. When a trader clicks the buy button, someone must be willing to sell. When a trader sells, someone else must buy. This simple exchange seems obvious, yet it creates a hidden dynamic that shapes nearly every movement in the crypto market. Many retail traders enter the market believing that price movement is purely directional. They search for signals, patterns, or indicators that suggest whether the market will go up or down. But large market participants often focus on something different. Instead of predicting direction alone, they analyze where liquidity is concentrated. In other words, they look for areas where large groups of traders are likely to place orders, stop losses, or liquidation levels. These clusters of orders form what can be described as liquidity pools. They are zones where many traders unknowingly gather their positions together. For example, when a price repeatedly approaches a certain level, traders often place stop losses just below it or buy orders just above it. Over time, these levels accumulate large concentrations of potential trades. When price eventually reaches those zones, the market suddenly finds a surge of liquidity. Stop losses trigger. Positions close. New trades activate. From the outside, this can look like a sudden breakout or sharp reversal, but from a structural perspective, it is often the market interacting with stored liquidity. This interaction creates what some analysts describe as a liquidity sweep. Price briefly moves into the area where many orders exist, activates them, and then often continues in the opposite direction once that liquidity has been absorbed. For traders who entered positions based on common patterns, this movement can feel frustratingly precise, as though the market specifically targeted their trades. However, this phenomenon is not personal, and it is not controlled by a single entity. Instead, it emerges naturally from how markets function. Every large order requires enough liquidity to be filled without causing extreme price movement. If a large participant wishes to enter or exit a position, they often need access to a significant number of counterparties. Liquidity clusters provide that opportunity. In crypto markets, this dynamic becomes even more visible because many traders use leverage. Leveraged positions introduce liquidation levels, which are price points where exchanges automatically close a position if losses exceed certain thresholds. When many traders hold leveraged positions near similar levels, those liquidation zones effectively become additional liquidity pools. As price approaches these areas, forced liquidations release a wave of automatic market orders. This can accelerate price movement and create the dramatic spikes and drops that crypto traders often experience. What appears on the chart as sudden volatility is frequently the market interacting with layers of stored liquidity created by the traders themselves. Understanding this structure changes how one interprets market behavior. Instead of viewing price movement purely as prediction versus randomness, the market begins to look more like a system of interacting incentives. Traders place orders based on patterns and expectations. Those orders create pockets of liquidity, and the market naturally moves toward areas where enough liquidity exists to sustain large transactions. This is why some of the most dramatic market moves occur near obvious technical levels, such as previous highs, previous lows, or widely watched support and resistance zones. These locations attract attention, and attention concentrates orders. Once enough orders accumulate, the level becomes structurally important, not because of the line on the chart, but because of the liquidity surrounding it. For traders observing the market through this lens, the goal shifts from predicting every movement to understanding the environment in which those movements occur. Instead of assuming that price simply breaks levels, one begins to ask where large groups of traders are positioned and how those positions might influence liquidity dynamics. This perspective does not remove uncertainty, and it certainly does not guarantee success in trading. Markets remain complex systems influenced by technology, regulation, macroeconomic conditions, and human psychology. However, recognizing the role of liquidity can provide a more structured explanation for why price sometimes behaves in ways that seem counterintuitive at first glance. In the end, the crypto market is not only a place where assets change hands, it is also a network of incentives, expectations, and order flows interacting continuously. Liquidity sits quietly at the center of that system, shaping movements in ways that many traders only begin to understand after years of observation. And once that structure becomes visible, the market starts to look less like chaos and more like a complex mechanism where price travels not just because of belief, but because of the hidden pathways created by liquidity itself.